Hey, what's going on, everybody? Welcome to another edition of Wealthy and Wise Wednesdays, where I share a few words of financial wisdom to help put you back in the driver's seat of your financial future. Today is Wednesday, December 30th, and I'd like to wish everybody a early Happy New Year. And I would be remiss if I didn't point out that I was rocking the new Sneller Financial polo shirt on sale now for the very, very low cost of just $600, which I think everybody has in their bank account today. If not, it's coming soon. Anyway, let's get into today's topic. Last week I made some kind of inflammatory remarks as it pertains to the financial services industry and in the investment advisory world, and attacking guys like Dave Ramsey when I said probably better advice to follow than Dave Ramsey is a guy like Stephen Covey, who's not even a financial whiz. But with Stephen Covey's advice of begin with the end in mind, I started talking about things like retirement income and how you have to pay an enormous amount of tax if you save your money in your traditional 401k, and how that 401k can trigger all sorts of taxation on your Social Security benefits, causing you to pay tens of thousands of dollars back to the government for that entitled benefit. Now, I had a lot of people who actually really enjoyed that video, but I went in kind of like in depth on so many topics, and I figured it's helpful to actually have a visual. So I've got a little bit of a visual that's going to assist us here today, where we're talking about the three main places that you can park your retirement money and exactly how that's going to work when you start taking distributions for your retirement income. So the first bucket where you could place your money is in an account that, again, once you take distributions, the distributions will always be taxed. Bucket number two in the middle, when you take your distributions, they're sometimes taxed. And then bucket number three, this is the good bucket, where you take your distributions, those distributions are never taxed. Now, what are these three buckets? Well, bucket number one, when you take the distributions, they're always taxed, and they're taxed as ordinary income, which is the highest tax in the U.S. tax code, ordinary income tax. Right now, the top tax rates for ordinary income are nearly 40%. Now, bucket number two, these distributions in this bucket, they are sometimes taxed. And these are after-tax non-qualified contributions. So when you take the money out, the return of principal is tax-free, and the investment growth is what's taxed. And they're taxed at capital gains tax rates. More on that difference in a bit. And then finally, bucket number three, these are accounts that are never taxed. These are things like Roth accounts, debt, and life insurance. Now, you might be thinking to yourself, debt, life insurance. Well, most people are pretty familiar, I think, with the concept of a Roth IRA. We contribute after-tax dollars, the investment grows tax-free, and then upon distribution, the distributions are tax-free. But what about debt? How does that even make any sense? Well, consider this. If you were to buy a $250,000 house, or if you were to need a $250,000 mortgage, you take that loan right now and you buy your house. You're receiving the money right now so you can purchase a house. But are there any taxes due on that $250,000? No. Why? Because it's a form of debt, and there are no taxes due on debt. Now, the catch to that is you have to pay back that principal with interest, and that can add up to be quite a lot of interest over time. But what about taking advantage of it for business purposes? Well, do you know who does it? Our president, Donald Trump. You think he actually buys all of those buildings with his own money? No, he uses leverage. He uses debt. In fact, I did a Wealthy and Wise video on this concept a couple of months ago when his tax returns became public, and they were all the rage. But so he uses debt to buy his buildings and things like that, but he has to pay the interest back on that, right? Wrong. He has people who are renting those buildings and the tenants. Who do they make the check out to? Donald Trump. So he's using leverage. He's using the power of OPM, other people's money. And life insurance also uses the incredible power of leveraging OPM. And we'll get to that in a bit. But life insurance is a really unique retirement cash flow tool, but it's misunderstood by most. And it's attacked by guys like Dave Ramsey because it provides competition for the mutual funds and the term insurance that he's trying to sell you. Now, why do we set up life insurance? Well, because for a small premium, you get a really, really big death benefit, right? But within the tax code, there are some incredible benefits to accumulating cash value and how that cash value is treated upon distribution. Now, I use a special kind of life insurance, one that was designed and built in order to maximize the cash value growth and to maximize the retirement distributions. Now, as a former bodybuilder and a former professional wrestler, I like to call it life insurance on steroids. But probably a more appropriate name was dubbed by author Patrick Donahoe, where he calls it the wealth maximization account. So more on the wealth maximization account later. And then one last point of distinction, the difference between tax-free versus tax-exempt. Now, under current tax law, Roth distributions are tax-free. They are reported to the IRS, but under current tax law, they're tax-free. You have to file a 1099 though, and if they're always going to be tax-free, why are the distributions reportable? Kind of like how Social Security was always going to be income tax-free. Now, look, I'm not making any predictions here. I simply ask the question. But life insurance distributions are different. Life insurance distributions are a form of a collateralized debt. So there is no 1099. There is no reporting. And when you take a distribution, nobody knows that you've taken a distribution except you. Now, let's take a look at a hypothetical example here. What if we had a value of $1 million or a balance of $1 million, and we had it in your always taxable bucket of your 401k, your sometimes taxable bucket, like in your brokerage account, or if you had that in your life insurance policy. Okay, so $1 million balance in each. Now, let's say, just hypothetically, that you wanted to take a distribution of, let's say, $80,000. What would that look like upon distribution? Well, if you took $80,000 from your 401k, you're going to get hammered with all sorts of taxes. You're going to pay federal income tax. You're going to pay a state income tax. Depending on where you live, you might have to pay a local or a city income tax. That distribution would go into a calculation for a Medicare surcharge tax. So it could increase your Medicare premium. And a distribution at that level will trigger an 85%, it will trigger taxation on your Social Security benefit, making 85% of your Social Security benefit taxable. Okay. So that's how that works. So 401k, it's really nice when the money goes in, but when you end up taking it out, there's all sorts of problems. How about a brokerage account? Again, we kind of covered this earlier. The return of principal is income tax free. So let's say, for example, you take an $80,000 distribution. Let's say $40,000 of that is a return of principal, no tax due. So we're only paying $40,000 on the investment growth. But the investment growth is not taxed at ordinary income tax rates. It's actually taxed at capital gains tax rates, which historically have been much lower and much more advantageous than your ordinary income tax rates. And then again, on an $80,000 distribution, that would only trigger where 50% of your Social Security benefits are taxable. Now, between those two buckets, which one would you have upon distribution? The bucket in the middle, the brokerage account, right? But what have we been taught? Bucket one. Bucket one. Bucket one's really popular right now, right? At your workplace, how many times have you heard that you need to max out your 401k or max out your 403b? How many times have you heard that on the Dave Ramsey show or on the financial media or on the radio? Why? Because they make a lot of fees for having extra money under management. So it's good for them. And like I said last week, Your advisor loves your 401k and Wall Street loves your 401k probably a lot more than you do because they get more fees and you get less after-tax spendable income. More taxes to you, more fees to them. But what about this third bucket? What if we were taking distributions from a life insurance policy? Well, we could take an $80,000 distribution, but it's not reportable and there's no 1099. And as we build up that cash value within our account, it's protected. In most states, it's protected from judgments and liens and lawsuits. And another really good planning tool, again, this is just going to show that it's non-reportable, is life insurance cash value. It doesn't count against college financial aid. So you don't report this or claim it on a FAFSA form. But again, I'm kind of getting off track. Looking at retirement cash flow, what's the taxation? Well, there's no capital gains tax on life insurance distributions, no federal income tax, no state income tax, no local income tax. It does not count in the calculation for the Medicare surcharge tax. It doesn't count in the provisional income taxation to make your Social Security taxable. There's no ongoing advisor fees. And you could take an $80,000 distribution, have your Social Security benefits be income tax-free, and still qualify for welfare. And I mean that literally. Why? Because the tax code doesn't classify distributions from your life insurance policy as income. It's classified as cash flow. So on paper, you are dirt poor and you're broke. So guess what? You qualify for maybe another $600 stimulus check, but also food stamps, Obamacare, the government cell phone, all the government cheese because you show no income. So if we are beginning with the end in mind, which is spendable cash flow, which one of these three buckets is better for you? The bucket where you have more after-tax spendable income, no stock market volatility, access to your money while you're growing it, where you can leave a tax-free legacy to heirs, and where you don't have to worry about market risk, advisor fees. And here's another thing. I don't care who gets into the Oval Office. Look, if this strategy sounds intriguing to you, I am going to link my calendar link below in the first comment for a free strategy session. Well, I will teach you how to do this, where I will customize a wealth maximization account based on your goals and your savings capability to show you what it would look like for you, for your retirement cash flow. I'm excited to show you how you can fund your own personal wealth maximization account, how it can be the foundation of your financial plan, and how it can improve and optimize all of your other investments, whether it's real estate, whether it's Roth accounts, whether it's brokerage accounts, and whatever else. But again, this is the key foundational account that's going to help you take back control of your money from the financial matrix, from Wall Street, from the IRS, and from all of the fees that you'd have to pay to an advisor. Well, that is all we've got time for today. And that's my rant. I look forward to speaking with you. Take care.